Next, we got the unemployment update. So what I'm going to do is I'm going to go ahead and bring Rocky back on. So go ahead, Rock. It's up to you.
Let's talk a little bit. I got a couple slides on unemployment. Unemployment continues to fall, but it is slowing. Okay, we've seen a big decrease in unemployment from April to July, and you can see here on this chart the forecast that it's kind of leveled off. Will continue to fall going into the end of the year, but it's not going to be at the pace that we originally hoped for or saw in the first phase of this. Rehiring leveled off also in July when you look at the hourly workers working versus the pre-pandemic. About 60% of the people were laid off, either permanently or temporarily, and we're back about halfway, I'd say, at this point right now. And they're not projecting a huge, again, increase in this, but it will slowly get better throughout the year. This is the bright spot we were talking about earlier. Auto production appears to have recovered pretty rapidly. We were in about a 220,000 per quarter production rate in 2019. You can see that towards the right side of the chart. And then the big drop happened with COVID and everything was shut down. Well, we're back to about 120 and increasing. 120,000 production per quarter. We expect that to be back up in the 200,000 range by the end of the year, beginning of next year. Wanted to talk about the markets because, like we said at the beginning, we're near the record high we were at before this whole pandemic started. But we've really got to understand what's going on. So we've got a few slides here to show you what's really driving these markets. And when we look at this chart, what we have is basically the U.S. equity style returns. On the left side, the left green bars under Q2 is how mid-sized companies, small companies and large companies have improved in the second quarter. So mid-cap is up 24.1%, small cap is up 21.9%, large cap 20.5%. So this was through June. And year to date, though, when you look at the right side of the chart, they were still down for the year. Okay. When we break that down a little further, the bottom half of the chart, you can see it broken into growth stocks and value stocks. The large growth had the biggest second quarter recovery at 26.2, and they're actually running 7.9% ahead of the beginning of the year. And we're going to go into that in a second. When you look at the rest of these, you can see everything else, even though there was strong recovery in the second quarter, the other equity styles, mid and small companies, mid and small and large value stocks are the dividend stocks. They are all still running behind. So what's taking place in large growth that's not taking place in the rest of the companies out there? Here's another way to slice that information. It's by sector. So what we can see here, looking at the top of the slide, the consumer discretionary actually had the biggest rebound in the second quarter at 32.9%. And year to date, consumer discretionary companies are up 7.2%. Those are companies like your Home Depot, your McDonald's, things like that, companies that actually profited during that time because a lot of other companies were shut down. Technology is in the second place here, up 30.5% in the second quarter. But look at the year to date. We went through a recession and they are literally 15% ahead of where they were at the end of the year. Everything else, energy, materials, the S&P overall, communications, industrials, healthcare, real estate, financials, consumer staples, and utilities, everything else is down in the S&P, but technology and consumer discretionary. So let's dig a little deeper. I want you to focus on the left side of this chart. The left side has a new acronym we have for you called FNAMA. Not banana, FNAMA. What FNAMA is, it represents the 6 largest technology-related stocks in the US: Facebook, Alphabet, which is Google, Netflix, Amazon, Microsoft, and Apple. The year-to-date contribution of those 6 companies is up 5.3% year-to-date. And the beginning of the year, we were in pretty good shape versus the rest of the S&P. So all the other companies minus those 6 actually are down 8.43%. And I want to focus in on the next slide too, which puts it in perspective with the rest of the world. So when you literally take the S&P, which on this graph is in the green, you see the growth from the beginning of 2015 through 2020. Okay? You take the total S&P, including those 6 companies, you see the huge growth that has taken place. But when you subtract out just those 6 companies, the rest of the S&P represents the gray line in the chart. So you can see how much less without those 6 companies, Finama, right? Facebook, Apple, Alphabet, Netflix, Amazon, Microsoft, and Apple. Without those 6 companies, our growth has been relatively in line with the rest of the world. The orange represents the international equity market. So what is really driving where the market is at today? 6 high-tech, large high-tech companies. That's what's really driving this market. And if you know anything about the technology sector, it's one of the most volatile. So you have to understand that's why there's also increased volatility going on in the S&P, because those 6 companies play such a huge part in the overall performance in the United States.